Welcome to this explainer, where we're diving deep into the massive post-merger world of CelcomDigi Berhad and its overall financial health. We're looking at a truly fascinating case study here. I mean, what actually happens when two absolute industry heavyweights join forces to create a powerhouse in the telecommunications sector? Well, let's find out. To really wrap our heads around the sheer scale of this 2022 merger between CelcomDigi Berhad and Digi Telecommunications, you have to realize that they now serve over 20 million customers. Just to put that into perspective for a second, that is well over half the entire population of Malaysia. It's just a staggering footprint. They are officially Malaysia's largest telecommunications company now, holding equal major stakes from the Axiata Group and the Telenor Group. From your everyday mobile and broadband all the way to smart agriculture and 5G, their infrastructure is literally touching almost every single facet of the nation's digital transformation.
All right, so here's our roadmap for today. Number 1, we'll meet Malaysia's telecom giant. 2, we'll ride the 50-day price roller coaster. 3, we'll get inside the financial ratios. 4, we'll look at macro impacts and 5G expansion. And finally, number 5, we'll deliver the verdict on CelcomDigi. Let's get right into it.
Part 1. Meet Malaysia's telecom giant, the foundation of CelcomDigi.
Okay, a really crucial baseline to establish right off the bat is that CelcomDigi is a Sharia-compliant equity. Basically, this means the company adheres strictly to Islamic investment principles, completely satisfying the screening criteria set by the Sharia Advisory Council of the Securities Commission Malaysia. Now, you might be wondering, why does this status actually matter so much? Well, because Malaysia has a rapidly expanding Islamic capital market. By keeping this status, CelcomDigi isn't just appealing to your conventional investors, they're making themselves highly attractive to a massive pool of Islamic investors who are hunting for ethical, compliant growth opportunities in the digital space.
Moving on to Part 2. The 50-day price roller coaster, tracking market sentiment.
Let's zoom in on the micro level for a moment and look at exactly how their stock performed over a recent 50 trading day period, specifically from March 30th to June 11th, 2026. It was a bit of a roller coaster ride, honestly. The stock opened at RM 293 and ultimately closed down 8.53% at RM 268. Now, if you just looked at the start and end points, you might assume it was just a straight drop down, but there's a lot more nuanced at how the market actually valued the company day by day.
We can essentially break this 50-day window into 3 distinct acts. Act 1 was a steady climb from that opening RM 293 up to a high of RM 320 by May 15th. Then we hit Act 2, a plateau or consolidation phase where prices just fluctuated in a narrow band between RM 305 and RM 319. And finally, Act 3, a pretty sharp drop in early June, bringing it down to RM 268. You know, while telco was generally considered a really stable, defensive industry thanks to those reoccurring customer subscriptions, they absolutely aren't immune to shifting market sentiment, economic uncertainty, and of course, the really intense competition from rivals like Maxis and U-Mobile.
All right, Part 3. Inside the financial ratios, the 2024 versus 2025 breakdown.
To figure out the actual health of the company beyond that short-term 50-day stock dip, we've got to look under the hood at their 2024 and 2025 financial ratios. Let's make these numbers human, though. We'll look at what they actually mean for efficiency, confidence, and, importantly, risk.
First up is their efficiency or return on equity, which jumped from 8.5% to 9.5%. This is a fantastic signal. It means the company is literally getting better at generating profit from the money shareholders have invested. Meanwhile, investor confidence pushed their price-to-earnings ratio up from 25.7 to 28.3. So even though the stock had a bumpy 50 days, the broader yearly view shows that investors are totally willing to pay a higher valuation. Why? Because they're fully expecting future earnings growth and improved financial performance.
Now, if you're an income investor, you are absolutely going to love this next point. The dividend yield climbed from 3.95% to a very attractive 4.54%. This shows that shareholders are getting a higher return on their investment through dividends relative to the market price of the shares. Whether this comes from the company bumping up its dividend payment, a slight drop in the share price, or maybe a mix of both, it really solidifies CelcomDigi's reputation for handing out steady, consistent payouts. But here's the catch: debt. It's a classic double-edged sword. Their debt-to-equity ratio rose from 81.2% in 2024 to 88.4% in 2025. This points to a much heavier reliance on debt financing. Now, while taking on debt is totally normal for any company investing heavily in its own growth, it does dial up the financial leverage.
It's one of those metrics that requires really careful monitoring, because an excessive reliance on debt could elevate their financial risk down the road, especially in an environment where interest rates are shifting.
Section 4. Macro impacts and 5G expansion. The big picture forces.
So zooming back out for a second, how do massive macroeconomic forces interact with all these internal numbers? You've got to ask yourself, is a telecom giant heavily impacted by things like rising inflation and changing interest rates? Well, telecom is an essential service. That means people are going to keep paying their phone bills even when money is super tight. But they aren't completely shielded from inflation either. They still face rising employee salaries, maintenance costs, and energy expenses. But more importantly, they face massive borrowing costs. Remember that rising debt ratio we just talked about? Rolling out advanced 5G networks across the entirety of Malaysia requires intense capital expenditure. If interest rates go up, the cost to service that mountain of debt goes up too, which could really start to weigh on their price-to-earnings ratio. On the flip side, though, strong GDP growth acts as a huge tailwind for CelcomDigi. A growing economy boosts enterprise and consumer demand for digital connectivity, cloud services, and the Internet of Things.
Finally, Section 5, the verdict on CelcomDigi, their long-term potential.
The report actually concludes with this really powerful statement. Basically, despite any short-term market fluctuations, their strategic alignment with digital trends and their Sharia-compliant status makes them fundamentally attractive. We're talking about a defensive stock with highly stable cash flows, a deeply entrenched customer base of over 20 million people, and a company standing right at the very forefront of Malaysia's digitalization and 5G expansion.
And that leaves us with a pretty provocative thought. When you weigh it against the massive potential of a nationwide 5G expansion, rock-steady dividend yields, and a prime position in a booming Islamic capital market, does the short-term 50-day 8.5% dip really change the long-term story? Or is it simply market noise, masking a highly efficient, highly confident telecom giant that is literally laying down the groundwork for the next decade of connectivity? Thank you so much for joining me for this explainer. I hope it gave you a really clear, structured view into the financial architecture of CelcomDigi. See you next time.